All right, yields in crude oil pushed stocks lower today until we had a nice little bump and a rally from some positive news out of Great Britain regarding Brexit, as well as a nice little run on Boeing to help lift stocks up towards the end of the day. But we're continuing to see bearish patterns on the Russell. We're getting increasingly bearish patterns on the Dow. Does that mean that we should expect to see not necessarily new strong bearish trends, but some more weakness in the S&P and the NASDAQ to come? I'm going to break all that down in today's video. Take a look at a sector that didn't quite perform as you would have thought. It was kind of a little bit of an outlier relative to expectations today, and we're going to trade that sector with today's trade example. So let's go ahead and get started. Today is Wednesday, March 27th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the bearish posture we continue to have, so the intermediate line continues to fall down. In fact, the intermediate line is kind of crossed through below the market sentiment line. Now, that's not always the biggest deal. I mean, you can see over here a cross down and bounce back up, and cross down and bounce back up. I mean, that's what it does. So, eventually it will cross down and then go down and bring the market sentiment line with it. So that's a little different situation here. But again, you can even see a very similar period here where we were bearish coming off of that intermediate pullback that we never did get over here. So, so I wouldn't put a lot of stock into that crossing yet. I kind of view that still, especially since we're just barely a month into this crossing versus, say, over here where it crossed over in the reversal zone, mind you, as well. It was, a few months after the market sentiment crossing above 50. So it's not like we're heading into a bear market here like we saw that last time it crossed below. I'd say, though, that we are potentially in this intermediate pullback zone. I mean, we already are on the Dow or the Russell 2000. The Russell 2000, you notice, it will turn red today or tomorrow. So we will have the combination of dark pink shading, red line, and the three red arrows you'll see here in a minute. The Dow is actually close to that. So the Dow has got the light pink shading, not dark yet, but it's getting closer than any of the other indexes. You can see we are below the moving average. So it's yellow, and it's not going to turn red tomorrow, but it's slowing down. That's the next index that's closest to that bearish pattern. Of course, the NASDAQ's still easily above its moving average, and so is the S&P 500. So, I mean, those lines are still green. They have to turn yellow before they turn red. I mean, they can go from green to red, but usually they're pretty flat by the time that happens. So, we'll see. We'll see. Maybe by the time the intermediate line gets below 50, the green line will have flattened out to get to that point. So, yeah, we have a weak bearish posture. We're not looking at any kind of trend change here anytime soon. More just simply, again, as I mentioned before, this Fibonacci pullback that we haven't had yet, that we expect that, whether it goes down to 2665 by April the 9th, whether it only gets down to 2740, I mean, that's where the next layers of support will be. Also, as you can see, I mean, those are the layers that line up with the volume profile, right? You have a big layer of volume support here in that area where that first Fibonacci support, where the 23% Fibonacci level is, and then the next layer of resistance right down here at that 26, kind of 65 to 45 area, where the 38% Fibonacci retracement level is. So lots of support below where we're at. No, I'm not worried at all. I know the headlines and the news coverage is actually kind of getting a little bit more gloomy, especially with the yield curve inversion being a dominant story. But the reality is the yield curve inversion is actually a very bullish signal for stocks from that point going forward until the yield spread starts to rise, which we're not seeing a significant rise yet. And usually this significant rise comes from the fact that the Fed is lowering interest rates. We're not to that point either. So that's kind of what we're seeing here again. Still strong. We're still, I mean, yeah, we have light pink shading, but the reality is it's still a bullish trend. Even with the intermediate line falling, it's when it gets below 50 that's when it turns bearish, and even then it can do it briefly and just have a the intermediate pullback, which is what I expect this will be. Right? If we have any kind of bearishness, it will be brief. It will most likely be brief. Of course, anything can happen, but it will most likely be brief, and it will simply just be Fibonacci retracement down to support. For the Russell 2000, you can see where that support is. Whoops, not there. Maybe more in this area here and up to the high point. So, we have fallen already to the 23% Fibonacci retracement level. That's where we're trading at right now. The next layer would be 1471. So the Russell may be giving us that kind of precursor of what we expect to see in these other indexes. Alright, before we look at some other charts, reminder, subscribe to our YouTube channel. Mouse over our logo right here. Click that red subscribe button that pops out. There's also a subscribe button down below the video if you're watching it on the desktop. Also, while you're down there, click that thumbs up icon. That tells me two things. Number one, you got something out of the video today. You liked it. Number two, you want us to do the video again tomorrow. So quick, easy way to give us feedback. We look at that comparison to how many views we're getting, because that tells us how many of you like these videos and want us to keep doing them. Go ahead and click on. We appreciate those that do click on that thumbs up night after night. Also down there, comment anything that stood out to you. What did you get out of the video tonight? Go ahead and comment down there below. Subscribe to our daily Market Outlook email list. There's a link popping up there in the top right corner of your screen. Very easy way to subscribe. Click on that link. Follow me on Twitter for more content like this in between these videos from day to day, and then join our Market Outlook community that we've created on Facebook. If you're watching our videos in the blog, you can see there's right below the video, there's a very easy way to subscribe to our email list too. Just click here in this form, your first name, last name, email address, and sign up. Very, very easy way. For those that get the email, this is what it looks like. Also has a link to the video if you're not at your computer. You also have a timestamp summary of these contain links that take you straight to that segment in the video, so you can be able to do that. And what a lot of people don't do is scroll down to the bottom where the list of clusters are. These are the overbought and oversold clusters inside of the S&P 500. So make sure that when you do get that video that you scroll down to the bottom to check that out. I've had a lot of questions actually where those lists are, and again, they're just at the very bottom. And also, I don't think a lot of people realize about these timestamps. Very easy way to get to these specific segments in the video if you're looking for a quick review. While you're here, also click this little heart. That takes you to tonight's Market Outlook tweet on Twitter, where you can like that there. If you click on this image, it takes you to tonight's Market Outlook post on Facebook. You can like there and share with friends. Again, same thing on those. Well, we look at those to see your feedback on whether you appreciate these videos and want us to keep doing them. Very easy way you can click on those while you're watching here. And then here's our upcoming calendar of classes as we wrap up the week. Alright, now let's get back to the charts. And again, you remember that long upper shadow can act as a weakness, a sign of weakness for stocks, especially in the longer term. So whether or not this 1 or 2 days will act as the pullback or not, the expectation is it'll probably last a few more weeks. We'll probably get a few candles here, a few bearish candles with the transition candles that we're getting on the Hakinyashi. Would expect to have a few bearish candles, kind of a pullback here. Before we bounce it. Here's that last intermediate pullback that we can compare, where kind of in the middle of a long-term run that we would compare this to. In fact, we'd actually be here more towards the beginning of a long-term run, and you can see how you can get a few Hakinyashi bearish candles before you turn back up, turn back higher again. Let's take a look at the 3 green arrow chart now, and that's where we see we're not anywhere near 3 red arrows with a declining moving average on the S&P, but we are on the Russell. We already have it, right? This line will turn red tomorrow. We'll have the 3 red arrows and the red line, just like on the market forecast. Now, does that mean that we're going to tank or head down like this? Not necessarily, but it does mean that that this we've already been showing weakness here. We're probably going to see that same weakness on the S&P eventually in the Nasdaq once their relative strength wears off. The Dow is really close to getting that same signal too. We got the 3 green arrows and the falling moving average. When you look at the 2-line versions of this, the S&P has easily got the MACD above 0 and the stochastics above 50. Yeah, they're showing weakness coming down below falling moving averages, but not huge weakness, right? Not trend changing weakness. But as I mentioned before, the Russell is showing that, like the MACD is below 0, the stochastics is below 50, little bit of a divergence forming here on the stochastics as of right now, not on the MACD. We are below a falling 8-day moving average, even with the bounce, with the 8 and the 17 both below the 30. Now, if you take a look at the Dow Jones, remember that's the one that's closest here. Its 8 and 17-day moving averages are also below the 30. So we're bearish up there. The MACD is flirting with that 0 level, getting below it just a smidgen, and the stochastics is also flirting with 50. So, you know, it's the next one. It's flirting, and it's got this little consolidation pattern triangle that you can expect to bounce up to the upside. That's the breakout to the upside. That's what the consolidation would suggest. So again, I mean, we don't have to fall. That we are just getting some consolidation in the pullback, but we still haven't got that weakness yet here that would say, okay, now we can go up for another 3 months, right? 2 to 3 months. Rally similar to this, similar at least to this pace here. I wouldn't expect that from this point because we haven't had deep enough of an exhale. We continue just to have shallow exhales. Eventually, that's going to come home to roost because you can't hyperventilate forever. All right, now let's take a look at the intraday chart, and you can see we're flirting with the midpoint of the range still. We're also flirting with that lower shadow on the Heikin-Ashi. The purple line's the open, so we've already had some trading this week below that line, and not very much up above it. So that's why we're not getting very much of a shadow, you know, upper or lower shadow here. Very small range so far on the week compared to last week's range and the week before, which had a really high, big range. We did get a lower high and a lower low today on the S&P 500. You can see on the IWM we also got a lower high and a lower low, and we're easily in the lower half of the chart. Diamonds is also stronger into the lower half of the chart than what we see so far on the S&P and especially on the NASDAQ 100, which is the strength of the market right now. If you take a look at the volume for the S&P 500 on SPY today and the range, you can see the volume ended up being a little bit more than what we saw yesterday. Still below average, 72 million. The trading range was just under 4 points, so that was a relatively larger trading range. So you know that will serve to bring this up. Again, those are the ranges we like to avoid because we're not going to have a bunch of upper bullish days in that range. Last 3 days that we've had, they've all been 2 of the 3 have been down days, so which is very typical. Volume is still pretty light. You can see we're still below that average, but the average is rising. So when those 2 lines rise, they typically rise with weakness, and you can see during this intermediate pullback we had a little bit of a rise here. Doesn't have to be huge, and it didn't get up to high levels, so it was just a pullback. And so that's, we're kind of flirting with that 1% level here. We'll see, it doesn't have to go up very much here just to get that intermediate pullback down into this area that can serve for a better launching pad than the one that we're currently on right now. All right, finally, let's look at volatility. And you can see volatility is relatively high. It's at 15. So we did come off of the highs of the day. We're at that 90% level. So we're at a little bit of support right now. There could be the expectation is we can bounce off of this and move up and closer to this bearish range, similar to what we saw at the beginning of the month. Looks like we're kind of forming a higher low point. If you look at it on this other chart, we've got a little bit of a higher low developing with the MACD and stochastics. And again, you would expect a higher high to come off of that. So we'll see if that ends up being the case. Or if we break back down below 15, then we're going to continue with this inhale, right? Then the exhale is done. We'll continue with the inhale. Ideally, we'd not want that, right? We'd like to get more of a exhale, and then we can really buy that dip. But if we do continue higher, we continue higher, and we manage our trades accordingly. So to summarize, the markets are showing signs of this intermediate pullback that we've been expecting, and we are in the midst of that. It's been slow. Like we haven't been tanking here, so it's actually a really good sign that any pullback we get will be just that. That it will just be a temporary weakness before we re-engage this long-term bullish trend that we're on now. So that's a good sign, but it does mean that we'll have, it won't be straight down, right? If anybody's expecting bearish trades to really make you a lot of money on any kind of pullback, it doesn't. On the bullish pullbacks, on bullish trend pullbacks, it's not too bearish, right? It looks a lot like this, where we're up and we're down, and the downs go a little bit lower, and then we bounce up, and then the downs go, that's very typical of bullish pullbacks. And as long as we get a little bit more of that, then it sets up very nicely for a good end of the year, middle to end of the year run. So what do you think about that outlook? There's a link popping out in the top right corner of your screen. Click that link, it opens up a poll, then hit either agree or disagree. If you click disagree, in the comment section below, tell me what you're seeing, and that would suggest something different than what we came up with here from our outlook routine today. All right, now let's take a look at what's driving the price action today. You can see, again, bonds continue to be an outlier, and this was an outlier up to the upside now to today, and with crude oil being the biggest driver to the downside, and that has been and continues to be a driver of weakness for equities. You can see international stocks dropping today. You can see small cap stocks, or at least emerging markets, developed markets outperforming. In fact, they were up on the day, but emerging markets and crude oil down. The dollar was up a smidgen. That didn't keep. It put pressure on gold, it put pressure on commodities. Put pressure on international stocks, but developed markets. Some relatively positive news coming out of Great Britain relative to Brexit, helping keeping it outperforming today. In fact, outperformed pretty much everybody except for high yield bonds and the dollar, and especially Treasury bonds. So if I were to zoom this back out here to the week so far, and you can see, it's interesting to see, and it's been a really today's rally in treasuries that pushed it up, and the weakness that we're getting in small caps, those are your biggest. I mean, you don't really see these categories all together: small cap stocks, developed markets, crude oil, and bonds, but they're all up because that's the kind of move. I mean, the crude oil and small caps had a great Tuesday, and they pulled back a little bit, and treasuries have had a good day today. And on the downside, not surprising, emerging markets and gold suffering the most from this week's some short-term strength that we've had in the U.S. dollar. Now, I did talk about in class today, in our options inventory trading class, we took a look at the market forecast on a weekly chart, and let's go back 20 weeks, and there'll be a reason why here, on TNX, because the yield curve is inverting, right? And at least parts of it are inverting. You can see the short term still is really high because of the Fed's holding interest rates steady, and are expected to for most of the year. In fact, if there's going to be any move, the market's pricing in the odds of a rate cut. But you notice that we're getting clusters, these clusters in the weekly charts. Last time we had that inverted yield curve was here. And you can see the yields fell after the Fed raised rates for the last time. Yields fell until we got to clusters. Now the Fed funds rate was up here too, so the 10-year note actually fell below the Fed funds rate quite a bit before we finally got the clusters. The Fed fund, which is probably the reason why the market reacted so strongly in December. The 10-year note was way up here. The Fed funds rate's actually right where we're at. So we had really extended away on the 10-year note to the Fed funds rate, and now we've pulled back down to it, and we're getting clusters. So there's a little bit of a lower bound here on the yield. So yeah, we're falling a lot, and we're nowhere near starting a new bullish trend in yields anytime soon. But if you're looking to now buy bonds right now because of this great move that they're on, there's not a whole lot of return potential left in being bullish on bonds. There's a good opportunity here for bond yields to bounce up. Now, I don't think we'll bounce up to new highs, but I do think that we'll have an opportunity to bounce up to a high, probably into this area here, before we get a new round of weakness. Again, remember, with the Fed not raising rates anymore, that's typically bearish for yields, but it's not, doesn't have to necessarily mean, I mean, we've already been pretty bearish. We don't necessarily have to drop precipitously down to the downside. In fact, if you take a look at, let's look at the volume profile for TLT, which is the most common long-term bond. You can see how we've really broken out on the 1-year chart. That's why we moved up so much. There's no volume up here. But if I were to back out and take a look at it on a 5-year chart, there's, we can move up here towards 130, and that's where you're going to find your next area of resistance. on long-term bonds. So there's some bullish opportunity. We might get a little bit of a pullback, and there's going to be some very strong support here at 120. So I'm not, any kind of weakness we get will be very temporary and short-term in bonds, because I do think, the Fed's not going to raise rates anytime soon. There's no inflation. The inflation expectations are continuing to move lower. Let's see when this was updated. Zoom it all the way over here. You can see this was updated as of yesterday, and we're back down below 2%. So there's no inflation expectations. Those are the two things that drive yields higher. They usually work together, right? Higher inflation expectations and higher rate hike expectations as a result from the Fed, and both of them are not. So we're not going to get higher yields anytime soon from those things. But we will get higher yields from simply being oversold, or at least overbought on bonds, oversold on yields. So I do expect a short-term bounce, but there's very, very strong support underneath us on bonds, and a lot of opportunity still for it to continue to trend higher. And that's not necessarily bearish for stocks. It might be some relative weakness for U.S. stocks relative to internationals, especially if the dollar continues or rolls over. You can see it's the dollar can't get going to the upside. If I were to take a look at a long-term view here, the dollar really can't get going to the upside, but it's not falling either. We're kind of stuck in this range. Breaking above 98 will be significant. Breaking below 94, really 95, would be significant to the downside. And we haven't done either. So until we do either, we're kind of just mired. But the odds are, if we're going to break out above or below either level, most likely we'll probably break down below 95 first. Because again, that's typical of when yield curve inverts and the Fed is done raising interest rates. All right, let's take a quick look at the calendar. The big thing that came out was trade numbers, and trade, you can see globally, has really been dropping. But here in the U.S., exports jumped up, but still the trend, from a very low number, but that was more of an anomaly. You can see the trend continues to move lower, as well as the imports. This is year-over-year growth in imports and exports. So, trade is as a reflection of demand. Global demand is for both U.S. consumers and abroad are really kind of moving lower. So that's not really the most bullish sign. Of course, economic indicators, let's refresh to see if it's been updated for today. The economic surprise index remains down. The odds for a rate the rate cut is trading right around, let's see, 64% now, and it was flirting with 70% again. When it gets to that 80% mark, that's when you know that the market is pricing we're going to get that rate. There's a very good chance we'll get that rate cut. And then finally, if you look, see, that was for October. This is actually December here. Oh, so we do have the about 75% chance of a rate cut by the end of the year. Still not below that 20% mark. But you see, it's really starting to climb relatively quickly because of this, because of how bearish we are, not just here but abroad, and because of indicators that look like this. I mean, it's not below zero, but they're not nearly as bullish as they were, and it's heading lower. All these indicators are heading or trending lower. GDP estimate for the first quarter is moving back higher again, so it's a good sign. We'll be updated again here at the end of the week. But still only 1.5% is a small number relatively. Pretty decent number for the first quarter, because seasonally this is the most bearish quarter. And it will be interesting to see if this ends up being a reflection of, if this continues to be some weakness throughout 2019 and not just limited to this quarter. Again, weakness relative, even though the line's rising, it's still a smaller number compared to the last few quarters that we've had. All right, now let's take a look at what's driving the sector rotation. You can see the biggest losers from a sector standpoint was healthcare today. Healthcare continues to show some relative weakness, a merger in that space. It was the biggest loser in the morning at the lowest point. It ended up being the biggest loser. It continued to show relative weakness even as the market bounced. The market bounced thanks largely to Boeing. Boeing rallied, that brought the industrial sector up. You can see materials also moving up higher. On the other end of the spectrum, technology, communication services, those FANG stocks, it's not surprising that they would give back some of their gains. Financial stocks, relatively, they had a good bounce, but then they pulled back at the end of the day here. And then you can see there's energy. Energy was also a big loser. Not surprising. Crude oil was down. So, so sectors are kind of following those trends. That healthcare sector really kind of stands out. if I were to zoom out here and go back to the week so far this whole week, you can see that healthcare sectors was outperformer, was a decent mover early, but it's really had a bad couple of days. And if I were to go out to the last couple of weeks, so the last 2 weeks here, you can see you got financials, not surprising, they're struggling. Gold's putting pressure here in this material sector, and Boeing, of course, with its influence on industrials, and healthcare. I mean, those are all the sectors that are down. Those are what's driving the broad market down, right? With all the FANG stocks mostly up here to the upside, and consumer stocks with staples, and you, of course, utilities and real estate's benefiting from the drop in yield. So the one that really kind of stands out, that's not kind of following what it should or what you would expect it to do, is this healthcare sector. So for our trade idea of the day, I want to take a look at a stock that's in that sector, particularly United Healthcare. A little bit of a doji pattern today, but you can see the bearish trend that it's on, dark pink shading, dark red line. If you take a look at the 3 green arrow chart, you can see it's also got 3 red arrows with the falling moving average. You break those lines down, and you can see here that the 8-day is below the 17. The MACD had flirted with 0, is now falling back below its moving average. Same thing with the stochastics, both in the lower halves of their charts. If you take a look at the trend strength indicators here, here's the death cross that United Healthcare is showing. On a weekly chart, they're still relatively noisy. We haven't broken down out of this descending triangle yet, but on the daily chart, you can see the trend strength and the bearish trends strengthening, right? As we get to -1 and above 50, which probably will tomorrow, that shows that we're getting a stronger bearish trend developing. You can also see that on the DMI indicators, the same pattern here, UNH. You can see that we're above 25 on the red orange line, below 20. So we got an increasing strong bearish trend again developing here, with the ADX also rising back up above 25. And if you look at the DMI indicators, along the other DMI indicators that we look at, they're showing that we had popped up here on this little bounce off of the lows, and then this little pullback here in the last couple of days has brought that line back down a little bit, and at very low levels at 11. And then you can see this line's also moving lower. So things are looking relatively bearish for UNH. We do have earnings right before April expiration. So what we're going to try to do is take advantage of the trend and see if we can't sell that 250 call. The spreads are relatively wide. It is an expensive stock, so you have to flirt around with this thing to get in. And knowing that with wider spreads, the higher the chance you can take a max loss. So you want to position smaller than what you normally do. But you're getting enough credit here for $2.50 Y. You need 58 cents. We're getting enough credit for that 30% return on risk. And you notice that line right there is where the break-even level would be. So we'd have to really kind of get back up to these highs for us to not be bearish anymore. Really quickly show you that you can see the Hakinyashi bearish candle. So still no transition, despite the kind of up and down, still no transition candle. So we're still getting that bearish move. No upper or lower shadow like you get here when you get the transition on that candle. So we're going to try to take advantage of that and see if we can't get, as we've done before, at least half of that gain here before we get to that earnings announcement. Now volatility will kind of work against us, especially if the stock continues to drop. So it might slow it down a little bit. But if we get that move, we're kind of banking on the relative weakness in healthcare, the relative weakness within the sector of this particular stock. This has been a weaker stock within the healthcare space, and see if we can't ride that down to a quick gain over the next couple of weeks before that earnings hit. Now earnings isn't a bigger mover. This stock doesn't always move significantly on earnings, as you can tell here. But we'll hopefully we can get what we want to get out of it before it hits. Like I said, right before. If I show you this chart here and push that out another to 20 days. There we go. So, considering the wider spreads, considering that earnings announcement, position size smaller than normal for this trade. And then again, like I said, if we can get half of that gain up to 35 bucks here before that earnings, before expiration, we'll take it, and then we'll just move on to something else. That will require a continued move and potentially even a breakdown here out of this little triangle to the downside, which is what the indicator suggests that we can expect, especially with that long-term kind of death cross that we're seeing here. That consolidation, this triangle, you can kind of see what it looks like, and you know, the death cross that we're getting would suggest, especially that long upper shadow from last week, would suggest that we have some more downside potential to go. Alright, so that wraps us up for today, and now I want to hear from you. There's a link popping out up there in the top right corner of your screen. It takes you to our forums. Remember, you have to subscribe to our site to participate there. But open up any new thread, ask any questions or comments you have on anything we discussed in the video, or anything we didn't discuss. And remember, you can reply to others' threads as well. You get points on our forum, in our community, the more that you open new threads, reply to other threads, click those like buttons on the blogs. Those all things give you points within our community there according to our point system. So, as always, thank you very much for coming on. I appreciate your time here tonight. Remember to subscribe to our site, click that thumbs up icon, comment down below, follow us on Twitter for more content, subscribe to our daily email list, and join our community on MarketScholars.com as well as the one that we created on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.